All right, time to talk about condos. So what do we want to know with condos, right? Is condo the same as a homeowner's policy? Well, that's what we're about to find out, right? So we're going to start off. We got Paul's Peace of Mind Insurance carrying the day again, bringing a lot of peace of mind. And we got Paul's Insurance Agency. And, we're just keeping our mock insurance company going here. We got Paul Tester. He returns. And we got our policy number, right? So let's dive into what this is, right? So this is your opening letter. And this example here is going to be a renewal. So this renewal reflects adjustments to your personal property limit, right? So your condominium, your building item limits, your coverage A changed from 179 to 186. Okay, so it increased, right? So you have more coverage. Your coverage C went from 76,800 to 79,000, right? So your coverage C increased. Your coverage D also increased, right? So when we get down to the declarations page, we're going to explain all these. I also did a really deep dive on the homeowners video. So if you watch that, that's going to explain a lot of these coverages because some of these are going to be, exactly the same. But some of these are going to be different. So your A is definitely going to be different in a condo policy, right? And, we're going to get to that when we get to the declarations page and spell it all out, right? But let's just go through here and see what we got here, right? So, this is our, our opening letter. And I like how it spells it out because not all policies do this for you. Not all, policies are just going to spell out, hey, here's what changed since the last renewal, right? So this is spelling it out nice and clear for you. It's giving you your policy period, so there's no questions if you forgot. You're going to go July 15th, 2026 to July 15th, 2027. You got a 12-month policy. It's going to be $752. That's your premium. They let you know. They already sent it to your mortgage company. If you got any questions, 555 and find out, right? So try calling that number. See what happens. Maybe it's a real number. I don't know. But here we go. Also, it's going to start asking you questions. Hey, do you have enough insurance, right? So it's important that they make sure you have adequate amounts of insurance on your dwelling, on your structure, on your personal property. And again, we're going to get to what all that is if you're unfamiliar with it in a minute. And we're going to go over, the big differences with this versus a regular homeowners, right? Because this is, a type of homeowners, right? So like a homeowner's policy, you'd be like an HO3 or an HO5, which we dive into in that homeowner's policy explained video. This one here, a condo, is an HO6. So it's like a version of it, but, there's definitely going to be some differences, right? So, we're going to get to those. So, but this is cool. It's going to tell you to look critically at your declarations page, which comes after the opening letter. Do you believe you have enough coverage for coverage A? That's the amount you get for reconstruction. Is as close replica to your home in the event of a total loss, which we're going to get to. Take inventory to make sure your coverage C, which is your personal property, is going to be good, right? So, and they also let to your home's market value is totally different from what it would cost to reconstruct, right? So, what would it cost to reconstruct? Reconstruction cost is based almost exclusively on the cost of materials and labor, as well as demand for the contractor services, right? So where you are can make a difference, right? If there's not, it's tough for a contractor to get to you. If you're out on an island somewhere, it's going to cost more to reconstruct your home, right? Because it's going to be tougher to get the materials out there, and then the contractors commuting and all the different things like that. So, but we'll get into all this as we go. How much would it take? Each home is unique. How can you determine your needs? Ask you the questions, your home's age, your flooring, your heating. So all these things, foundation type. So we're going to get into all this. Structures surrounding your home. If you have a fence, a garage, a gazebo, a barn. A condo, probably not going to have too much of that. But let's dive into all this, right? So, and here's your personal belongings, all your basics, things to include. at today's prices, right? So that's really important. So that's really cool. I like that they put that there. Paul's Peace of Mind Insurance is also sending out a privacy policy. What do we do with the info? And this is important too, right? Sometimes, a lot of times we get this paper, we throw it in the trash, but think about it. You're giving your insurance company a lot of personal data, right? So, they're letting you know that they're aware that you're trusting them with their data, what they actually do with your data. So, you want to make sure that you you kind of have an understanding of that. I mean, obviously expect them to do the right thing. And, for the most part, that's what they try to do. But they let you know if they do use your data for anything, managing your claim, fraud detection. So I'm not going to spend all the time on this, but this is kind of cool. But look, this thing's only 13 pages. So let's keep going. So now we got, all these different things. So you got the 13 pages here. And then, we got this little important notice here about lead poisoning. But here we go. So this is a little bit of a flip, right? So a lot of times, we're down to page 11 here. All right, so we get down to here with the declarations page, right? So pages 11, 12, and 13, interestingly enough, are down, brings you down to here. And here is the, the declaration page is at the bottom, right? So it's kind of like a flip. So usually this is up at the top. It's one of the first things you see. And here, it runs you through all this other stuff. And then it gets to this. So a little bit of a flip, a little interesting how they do it. So declaration, this is going to be your main page. This is the page, if you're, producer, your agency, they ever say, hey, can you send me over the deck page? This is the page. This is what's going to have your coverages on it, and all that fun stuff. So this stuff, again, it's just now it's showing it officially on the declarations page, what the policy period is from 1201 to 1201. That's always going to be very important because that's when, that's kind of like the universal language with the insurance companies, put 1201. That way, if everyone always uses 1201, if you go from one company to another, it just makes it nice and easy where there's no gaps, no lapse in coverages, and that kind of thing. So over here, named insured. So when you see named insured in the policy, it's going to refer to this person, right? Paul Tester, right? And then this is something you want to look at. In this policy, it doesn't really make a whole lot of difference, but the mailing address here, is not always necessarily, the location of, where the property is. So the location, this is what's actually being insured. So that's what you want to take a look at to make sure that that's right. But let's keep going. And let's look at limits of liability, right? So coverage A. So what is coverage A? So that is where the big difference is going to be versus a homeowner's, right? So one of the first questions that you're going to be asked is, are you studs in or studs out? Okay. And make sure you get clarification on what they're looking for, right? Because I've actually seen it described the opposite way before. So you want to make sure you have it the right way, right? So the way that, I'm accustomed to using it is, we'll backtrack 1 second, right? So you have the whole building, right? The entire structure with all the units, and, who's responsible for the entire structure, right? That would be on the master policy for the entire, condominium, right? So the entire building, the entire structure, the association or whatever owns that, would be responsible for that, right? So you're going to have a master policy, and it's very common. And if you've had a condo for a while, you're probably used to getting this and, giving it to your insurance company. But the master policy is going to be very important to have, as well as the bylaws, right? So, make sure you try to have those on hand. It's just going to make your insurance quest a lot easier. But, if you don't have it, it's not a huge deal. You can just reach out to the property manager or whoever handles those documentations for you, for your condo, and just get those, right? So, you pretty much, when you buy a condo, there's a couple ways to buy them, right? So it's either studs in or studs out, right? So what the heck does that mean? So studs in, and again, this could be flipped, so make sure you get the clarification. But studs in would be that you're responsible for rebuilding the structure, inside, right? Inside the walls, right? So studs out would be that you're responsible for like the walls and the components in the walls, right? So that's a difference, right? So if you have coverage A, right? Now coverage A is to rebuild the structure, right? So on a home, if you just had a home, a single family home, and it burned to the ground, total loss needs a total reconstruction. That's what coverage A would be, a complete reconstruction of the property. And keep in mind that these are limits, right? That's the most that they're going to pay, right? That's the limit. So you want to make sure you have enough there, because if you don't have enough, you're going to run into some trouble, right? So you want to make sure you have enough, right? So how do they figure out coverage A? How do they know if you have enough? So what they're going to do is, we went over this in the homeowners policy, but just a brief recap, because you might not watch that because you might not have a home, you might just have a condo. So they're going to type every single thing in, right? They're going to type in your flooring, hardwoods, countertops, any kind of specialty thing you have. Maybe you have a bar. So anything that's like structurally part of the condo, that's what they're going to type into the computer. So you're going to be asked all these questions, in a questionnaire. Some of it's going to come just from like the property card and the data, and from the, from the town and the assessor's office. And, all this information is going to be put into a computer. And like we were looking at the top, when it was looking at reconstruction costs, it's exactly that stuff, right? And that actually gave you a pretty good synopsis that not a lot of policies give you right at the top. So, it's going to break down how much is it going to cost to rebuild everything to the way it was, right? Because the idea of insurance is to make you whole again. So, they're going to cover your risk of loss, right? And that loss would be, you had a condo in this condition and they want to make you whole again. So they want to replace, that what you lost, right? So that's why you have insurance, right? So that's the whole idea behind it. So you want to make sure you have enough to be able to bring it back to where it was, right? So that's why this is very important, and it tells you to monitor it right in your renewal. So, but that's how they get that cost, right? So in a home, everything gets put in, and that's what the cost is, right? With the condo, it's a little different, right? Because we got a couple different policies going on here, right? So you have the master policy, which is going to be for the entire, the entire complex, so the entire building, right, with all the units in it. So you're not going to be responsible to build the whole, obviously the whole entire building. What are you responsible for? And that's where the studs in, studs out comes in, right? So if you're responsible for studs in, everything inside, then your coverage A can be a little lighter, right? Because you don't have to worry about, what's going on outside of the walls, right? Maybe you don't even have to replace the walls themselves, right? Or any plumbing or electrical or any of that stuff with that. So, the master policy is going to be situated in a way, or set up in a way, that it's going to rebuild the entire building, but then it's going to stop at a point where you pick up, where your coverage A picks up. So where is it going to pick up? Is it going to pick up inside the studs, inside the walls? Or are you going to be responsible for some of the stuff outside of those walls, right? So that's where coverage A comes in. So that's where studs in, studs out. The master policy, that's why, the insurance agency, will need to take a look at that, the insurance company, to see, that. Well, the insurance company doesn't really get, they may, but a lot of times, the master policy is just kind of to figure out what kind of insurance you should have, right? And there could be other, bylaws and things could have other stipulations. Like maybe they say you have to have X amount of insurance in a certain category, right? So that could be in your bylaws. So that's why, it's good to make sure you're properly covered the way that your organization, your association wants you to be covered. You got to make sure you're following their guidelines. So that's why it's important to have those documents and be ready to send them out, whenever you need to, right? Same thing usually when you're going for a loan. you're probably going to need some of those documents also. So, so that's what coverage A is, right? So that's studs in, studs out. Again, caveat, I've heard it flip the other way, where they're thinking about what is the master policy. What are they responsible for, right? So that's how it gets flipped a little. So the master policy is responsible for the opposite. So they look at it like the opposite way. So just make sure you're looking at it the right way, okay? Let's jump over to C, right? Actually, before we do that, let's look at these letters, right? So in a homeowner's policy, you have A, B, C, D, E, F, right? You have all these, right? But there's 4 main ones, A, B, C, D. Those are the main ones in E. So I guess, yeah, that's a main one also. I mean, they're all main ones, but, there's these main ones, right? And with this, it's going to be a little different, right? So there's no B. So what is B, right? So B is other structures, right? So just think of B, behind the building or building. That's how you think of B. And it's something unattached, right? So in a condo, highly, highly unlikely you're going to have any B, right? You're probably never going to have B. And that's why you don't even see a B here. So that's why B is not on here when you'd see it on a typical homeowner. So that's one difference. So C, personal property, right? So this is all your stuff. And as we always like to describe it, if you were to take your home, if you're in a home, a single family home, or if you're in a condo, you shook it upside down, everything were to fall out, what would that stuff be? Stuff that's not really attached. That would be your personal property, right? So what's cool about a condo policy is similarly to your homeowners, is this is going to travel with you, right? So if you're down in Florida, you left your phone in the car because you were going to Disney World and you didn't want to have it, on the rides, and you decide, hey, I'm going to leave it in the car. That somebody breaks into your car, that would be covered, right? Because that's your personal property. That covers all your personal properties. That's what's really cool about these policies, is it's not just covering if something were to break into your condo and take stuff. No, it's everywhere. A lot of them say around the world, right? So, but always make sure, but that's what a lot of them do say. There'll be little small caveats. They'll say, excluding X, Y, and Z. So you want to make sure you read the fine print, right? So, also important to note, and I went over this in the homeowners, but this does not mean you just get a check for $79,900 because the place burned down. You say, hey, yeah, I had XYZ, I had 80 grand worth of stuff. Well, some things have limits, right? Things like jewelry, fine art. There's certain things that'll have, silverware. I mean, there's some odd things on the list, but some things have a limit, right? They might only give you $1,500 or $1,000 just for that one category. So don't think, I don't have a lot of stuff, but I got 50,000 worth of jewelry. But yeah, all my stuff combined is still like 80, so I'm good. You're not going to get 50 for your jewelry, okay? Unless, you schedule that out, as an endorsement on the policy, or you get a separate policy just for your jewelry. So if you have some kind of crazy thing going on, you want to make sure that you notify, your insurance so that, you can have it protected, if you want to protect it, or if you don't get it protected, you're going to find out the hard way when you file your claim thinking, hey, I had 79,000. Nobody ever explained this to me, how it works. And then, you're just caught in a bad spot because now you lost $50,000 in jewelry and you thought it was going to get covered because you thought you had $80,000 because you just saw this quick and you thought that that's what that meant. And that's not the case, right? So let's jump over to D, right? So what's D? So D would be your additional living expense, right? So this would be, let's say it did burn down, right? Well, let's say your neighbor flooded out the place, right? And you had to move somewhere else, whatever it is, right? You have to relocate. You have to go somewhere temporarily. This is going to help cover you in your relocation, right? So hotel room, wherever you got to go, moving expenses, things like that. That's where D comes in. So you got 31,000. Sometimes there's time limits on this stuff too. But that's your limit again of what they're going to give you in that situation, right? So what's coverage E? E is the big one, right? E is your liability, right? It's $500,000. So what this is going to cover is anytime you're liable for something, right? A lawsuit, a third party, you owe money to a third party because you caused them a loss, right? So, that could be something simple at the grocery store. Maybe you banging into somebody's ankle with the grocery cart, you weren't paying attention. Maybe your kid just starts rolling it fast. He's playing on it and he crashes into, some poor old lady, knocks her over. I mean, so many things could happen, right? Maybe he's throwing seashells at the beach. You turn your head for a second and he's throwing seashells and he trying to hit the seagulls or whatever he's doing. What kids do these sometimes, you turn your head like, what the heck are you doing over there? Like, what even gave you that thought to even that's even okay? And then, but maybe they hit somebody, right? Hit him in the eye or hit him in the head. And like, something just freaky happens, this is where this comes in, right? So those are smaller things, but it could turn into some big stuff, right? Because this could be litigation, lawsuit, all of that, right? And this is going to cover your legal fees, to fight what they're saying you did, right? So you want to have a lot of coverage here, right? So 500,000, that's the minimum you probably want to have, right? You hopefully want to have that maybe closer to $1 million, right? So let's look over here. Oh, before we look over here, let's also talk. We talked about this follows you around. Well, maybe you got the gist of that because we talked about being in the supermarket and different things. But yeah, this follows you around. So that's huge, right? That's huge, right? It's not just what happens in your condo, somebody slips. No, it follows you around. So very important to have, right? So now let's go over to F, right? F is your medical payments. So what the heck's a medical payment, right? So this is not for you. This is for someone else. Similarly to liability, let's say they're at your apartment. Your friend comes over, they trip, they fall, they turn quick, they trip over the couch or the rug's up and they trip on it, and they get hurt, right? And, you want to take care of them. You want to do the right thing. And, it's not going to be a crazy bill. So you might, want to just help pay their medical bills, right? So you have up to $5,000 per person for that situation, right? So what's different from this is personal liability. You have to be, at fault, right? So it has to be pretty much proved that you're at fault for the insurance company to pay this out. Obviously, legal fees help to fight it, as part of the thing too. But, they're saying you're at fault, right? Here, you don't have to recognize that you're at fault. You can just say, hey, here's $3,500. I know you showed me your medical bill. I felt bad. I know you, and I'm just going to take care of it. And it's not admitting that you are at fault. It's just like a nice way to kind of smooth over, making sure everything's right with everybody, right? So that's what's cool about that. So 5,000 is a good number to see there. 5,000 or 10,000. That's kind of what you're looking for. So what do we got here? We got our deductibles. So our deductible here, we have $1,000. Sorry about that. My Acrobat's getting a little acrobatic. So we got $1,000 deductible, right? So I'm sure most of you, unless you're brand new to this, you know that deductible is what you pay before the insurance pays. So you're going to pay $1,000. So you're sharing in that risk. The risk is $1,000. Whatever the risk is, all these things are covering, and you're going to pay the first $1,000. So obviously, because you're sharing in that risk, if you're going to share more and you're going to take more, then it's going to be different, right? So if you were to say $2,500, then your premium would go down because you're taking on more of the risk. You're saying, hey, I'm going to pay the first $2,500 if any of these things happen up here. So this one is interesting because it has identity recovery expense reimbursement. So you don't see this a lot on policies, but you got $250 for your deductible. And I like how they put it here. So you can see all your deductibles right here, right? So here's all your basic coverages, and then you have other coverages. So underneath here, so this is your basic policy. And then down here, you're going to get into your endorsements and your different things, right? Before you get into that, just a real quick thing. It's just showing you who the mortgagee is, and who they have an interest in your property, right? Because they you took a loan out for this condo, so they're very interested in what your insurance is for this. So they need to make sure that they are included in all of this, right? Because they have an interest in your property. So what's all this stuff here? So this stuff here is kind of a mix, right? So what do we got here? So what's interesting in a condo is a lot of times they're going to have these other coverages that are going to be part of the actual policy, right? So here we have the coverage level of optimum, and that's probably just one of the things that this carrier has that's going to include a lot of things, right, in this little package deal, right? So a lot of these things here, it's spelling it out for you, and this is actually better than a lot of like just regular homeowners, because a lot of regular homeowners on jewelry and stuff, you're going to see 1,000, 1,500, maybe 2,500, just on the basic ones. But this one right here, they're saying you got $5,000, right, on this optimum package, right? Silverware, $5,000, right? Theft of rugs, $10,000, right? So that's pretty cool. And then if you go down here, let's see what we got. Let's start off with this one, right? So this is going to have a premium with it, and this is going to be part of your optional coverage, right? So loss assessment coverage. So what is your loss assessment coverage? What does that mean, right? $60,000, right? So when you buy into a condo and part of an association with the condo and all that fun stuff, the master policy and all these things, right? There are certain shared areas, right? So like the roof and common areas, they're shared, right? So who takes care of that, right? So if something were to change with that, let's say they wanted to put a playground on the property, right? So you would share with that. They would send out a special assessment, right? And all the unit owners would get a bill, just kind of splitting the bill, right? Or paying a special assessment. So that's the lovely part of owning a condo, is you might get these special assessments, right? So also what can happen is there can be a loss assessment, right? So let's say the roof, something happened and it's a loss, and it's a major loss for the whole building. Well, they may send a bill out to all the unit owners and say, hey, we all got to chip in for this because this is our building. So you're going to get this loss assessment. So what this coverage does is it's going to cover you for $60,000 in that event, right? In the event of a loss assessment, right? So that's pretty cool. How much does that cost? $20. So let that sink in for a second, right? We got $20, $20, get you $60,000 in coverage if that were to happen. Right? To me, that's a no-brainer, right? So, that's our job, in the insurance industry, especially, somebody that's, trying to help you out, like a producer or an agency, or, they're trying to match, the best things of one company with, what works for you. I mean, we see something like that for $20 for $60,000. I mean, if we don't tell you about that, I mean, maybe you should throw us in jail. I mean, we got to tell you about that. So, and maybe you're like, hey, I don't want to spend any more. Like, nope, I don't want it. Hey, okay. But we at least got to tell you, for $20, you could get $60,000 worth of coverage, right? So some of these are kind of crazy, right? Almost on the insurance company's end. Like, really? Like, we're going to pay out 60 grand and we're only going to charge you $20. So kind of crazy with some of the stuff. So, but if you go through, I'm not going to go through all these. Building or ordinance, that's, let's say they had to rebuild and, the laws changed, the code changed, and they can't rebuild it exactly the way you had it. It's going to be additional costs and different things to get it right. They give you a little extra for that, right? 10%, that's included. It's probably part of that package up there. The fire department comes out, $5 grand. They could charge you some stuff. Service call, they got to come out there, right? debris removal, something happens, you got 5%. You got trees and things in a condo, you might not have a ton of that. But, it's just stuff that they throw on here. And when they design these packages to try to put the most things that make sense, and some of these things may carry over with like a regular homeowners too. They may just kind of keep things simple when they're doing their endorsements and their policies and their packages with certain components. So that could be that too. And this is a funny one. No, I shouldn't say funny. You don't want that to happen. But an arson reward. I don't see that a whole lot. But $25,000 arson reward, right? So here's a fun one too, right? So we got water damage, right? Water damage, right? $186,000, right? So what the heck does that mean? Water damage, $186,000, right? So you got to be careful with that, right? So if a pipe were to burst, and I don't want to use the word flood. I almost want to say it naturally, but you don't ever want to say flood, right? Because flood is not covered on any homeowner's policy, right? Unless you get flood coverage or you get a flood endorsement if they offer it, right? You might have to go to a private flood company, right? But water damage is not that, right? Water damage, that's why you got to be careful, right? You got to go read down what this stuff means, right? And let's see. Because just look down here, right? So if you say water damage, right, and 186, and what is 186, right? 186 is your coverage A, right? Your coverage A is 186,430. That's why that's so detailed down there, because it matches your coverage A, right? So it's saying, if a water pipe bursts and everything's ruined because of that, or whatever the water damage is, that you're going to be covered, right? Included, right? $186,000, right? And that's included. But then you go down here, and you got escape of water from a sump, right? So you're like, what the heck? I got $10. What the heck do I even need this for? Like, why am I paying $84 if my water damage is $186,430, right? It's like I was just saying, right? Water damage. I don't like how they worded this, honestly, because that's kind of like it's kind of vague, right? Water damage. I would think I'm covered if I read that, but you got to read these things, right? So flood is not covered, right? So this would be if you had a sewer or water backup, right? And it came out of the sewers and the drains, and that's what ruined your property, right? So that's not covered in a homeowner's either, or a condo, unless you get the endorsement, right? So that's the optional coverages here. Now we got endorsement, right? So that's a little telltale sign that water is not completely everything under the sun with water. They only mean certain things with water. So, but that's important. That's always one we like to add. Even though it might sound a little pricey to you, like $84, that's like $100. But think about it. You're going to get $10,000 if something were to back up. $10,000. You get, it's $84. So sometimes you got to think big picture with this stuff. Sometimes it hurts to part ways with some of this money, but sometimes it makes sense, right? But maybe it doesn't make sense. Maybe you're a risk taker and you say, you know what, I'm going to roll the dice and keep my $84, and then hope that the water never backs up, right? So let's look at, this other thing here. I think this is really cool. So you have this personal property replacement cost, right? So that's included. So that's something you always want to look for when you're looking at personal property replacement. What are they doing? Is it actual cash value, which would mean depreciation? So that means you buy a 70-inch TV, for $1,500, $1,000, and then what's it worth 3, 4, 5 years down the road? It's not worth that much anymore, right? But you're used to having a 75-inch TV, but even though it might only be worth $400 or $500 now, because it's older and used, what happens if it, is part of the loss, right? So you want to replace things at replacement cost. And if you remember way back at the beginning, that's one of the things that was asking you to take a look at with your policy at the beginning of this document. So but you want to make sure it's replacement, right? So you want to look for that word replacement when it comes to your personal property, when it comes to your structure, as many times as you can find it. You want to make sure it's replacement cost. So that's a big thing, and that's cool that that's included, right? There's some other things here, but I'm not going to get into all these different things here. Here are the forms, right? So typically those endorsements and different things might have a number next to it, and then you'd come down here and you'd find that endorsement, like this this HO6 1 2 3 4 5 6. You'd find the endorsement here. It's just kind of giving you the declarations page. You could definitely get this if you reached out to your insurance company. They would send you these forms so you could actually read everything over. Or they may just mail everything to you. Everyone's a little bit different. But that's how you would find and match up. If you wanted to find out more, like about water damage, you'd be able to find that out just by scrolling down to that section in the policy. So that's what all this is, right? All these things here, all these endorsements, they're taking a risk on you, right? If you really look at it, I mean, what's the premium on this policy? Is it $752? What the heck was it? $752, right? So they're taking an enormous bet on you, right? They're betting on you that they're only going to take $752 from you, yet they're going to pay out $186,000 to rebuild, up to $79,000 for your personal property, which that could be all at once, right? That could happen at the same time. You could be liable for something. That's $500,000. Sorry, my Adobe's acting a little funny. It's starting to freeze up over here. But $500,000, even $5,000, right? You're only paying $752. They might have to pay $5,000. That's like, well more than 5 years worth, right? Of you paying this, even if they just had to pay out one medical payment, right? So, I like to think of, the insurance company, it's almost like Vegas, right? So it's like they're playing the odds, right? So they have to play these odds just right? Or they're not going to be in business very long, right? If they're only charging you $752 and they're having to pay out $500,000, so they're having to pay out 186 or 70. I mean, they're going to be in a heap of trouble, right? So, it is a business, and I've gotten into this in my one of my other insurance videos, but it is a business. So, there's employees, there's an office, there's paperwork. They have to manage your account. They have to collect money. They have to make all these forms, right? They gotta do a lot of little back end stuff for each customer. And yeah, it may seem like, hey, I'm paying $752. Hey, we're back. We can see it. But we're paying $752. Well, we never use it. Year after year goes by. But you could pay this for 5 years, right? And then you do a medical payment just once, and you got all your money back. And I'm not saying get your money back, but it's just, how does the insurance company, survive like that, And that's one of the things that I really started looking at once I got into insurance, because I was on the consumer end, and I didn't look at it that way. I looked at it as, a necessary evil. I got to pay my insurance. I got to pay for this. I got to pay for that, because I never had, knock on wood, I never had a big loss where I had to, where this would happen, right? So, now I'm seeing the flip side of these things, right? So they gotta manage all this and be competitive with the other insurance companies, and they're not going to charge crazy high things because they're governed by Massachusetts Insurance, right? The Division of Insurance. So a lot of things play into the facts here, but that's what they're doing. When you really look at what they're paying, what you're paying versus what they might have to pay out, you can understand why some prices can increase, why they could just deny you altogether, not a claim that's valid. But I'm saying they may say, you know what? I'm not taking on that risk. Like, that's too much risk, too high of a potential. If you're somebody that files a lot of claims, there's a higher chance that you're going to file one of these claims and then they're going to lose all this money, right? And they got to stay in business, right? That's the name of the game, right? With every business, right? So it's a a good deal, I guess, for both sides, right? So you're getting some peace of mind that they're going to take care of these really big items if something were to happen, and then they're going to say, hey, you know what, we're going to take this premium and something may never happen, right? So, they're going to hope nothing happens. You're not going to hope something happens, but you're going to be happy that you have the coverage if it does happen, right? So, just to wrap up with the condo, big things, studs in, studs out. Make sure you find that out. That's a huge thing to know for your coverage A. Master policy, have the bylaws. Remember that these things follow you around, so they're very valuable. And, obviously your deductible. Think about that. And that's pretty much it. But if you ever want me to review your condo policy, definitely reach out. I'll take a look at it. See what you got. See if you fall short anywhere. See if you're right on the money where you should be. That's what I do. I look at policies all day and compare them and, try to make them better and see what the current rates are. And sometimes they're better, sometimes they're worse, so I'm an insurance producer, right? So why isn't my an insurance producer? Well, I try to think of it like a movie, right? So it's like you're the producer of the movie, right? So you're trying to find the best, insurance company, and you're trying to, get them matched up with the good client that they would like, and you're trying to get the client the best pricing with the right insurance company that works for them, right? You're kind of that person that's just kind of like, producing the whole contract to come together, right? So that's kind of where I think insurance producer came from. Maybe it didn't. That's how I picture it. It probably doesn't even mean that, but that's in my head how I I like to think of insurance producer. But that would be a good little research project for me to go see where producer came from. But that's just kind of what I think of. I think of a movie and a producer. But anyway, enough about that. Have a great night. About to wrap this up, and we'll get going on the next one. All right. Have a good night. Take care.
Thank you.